So there's actually three options, maybe even four for expatriates.
Very, very, very good question. These are just getting better, Jasper.
I know there's a lot of people that's very excited about both of these topics. I think it's very trendy and topics currently, buzzwords, expat tax and crypto. And I know I've been working with Victoria and Thomas from Tax Consulting SA quite a lot during the last month or so, helping a lot of our clients, especially with financial immigration. And we're going to go into depth in a moment, and even going through some case studies, because I think that makes it a lot more personal and exciting to see. So before I start, I'm going to give the floor to Victoria and Thomas, that I can do the introductions themselves. Yeah, I mean, you can choose. Maybe ladies first.
Thank you. Thank you, Jasper. Great. So me and Thomas both work for Tax Consulting South Africa, the largest independent tax firm in South Africa. And we specialize in helping expatriates with any compliance, non-compliance, tax residency, things like that, with SARS. It's quite an unknown topic that people struggle with. So we specialize in it. It's our day-to-day. We actually even wrote 2 textbooks on expatriate tax with LexisNexis. We're very proud of them, but they are very big. So if the tax doesn't interest you, you don't have to read the whole thing. You can just give us a call. Yeah, and I head up the division of expatriate tax at the company, and then I'll pass on to Thomas.
Thank you, Victoria. I'm legal manager at Tax Consulting South Africa. I deal with matters of cross-border taxation, especially concerning the interpretation and application of double tax agreements. When I'm not doing that, I also head up our crypto asset tax division, where we advise clients and assist them with their taxes regarding cryptocurrencies and similar investments, which is quite an exciting space to be in. We've seen our practice grow significantly to the point where, I suppose, Victoria, we now travel more than we keep still, having recently just returned from the UAE and Qatar, and very recently Netherlands. But we're excited for this discussion. Thank you so much for having us here today, Jasper.
I'm also very excited, and the people that I sent it out to was equally excited. I think there's a lot of people in that space currently, whether it's both or whether it's either or. But I think a lot of people are very excited and very interested in needing your advice at this stage. So I think let's go to expat tax first. I think that's and I'm gonna go through some questions. If there's any questions, I will look on Facebook as well if there's any questions. So I'll allow a Q&A after the first break in expat tax, and then we can head up to crypto tax as well. And then so I'm going to try to allow the time as much as possible for Q&A as well. So the expat tax, there's obviously this, when you're looking to potentially immigrate or moving between countries, you have potentially 2 options. As far as I see it, you have a financial immigration. It's kind of the final drawing the line, or potentially declaring once a year, need to declare to SARS, working on specific days and specific during the year. So if you want to maybe just give us a breakdown between the 2 options that you can utilize.
Absolutely. So there's actually 3 options, maybe even 4 for expatriates. Luckily, our legislation is still good enough that it allows for, a bit of flexibility, but it's all very case dependent. So always get personalized advice. Never just assume the blanket approach. I mean, in South Africa, SARS kind of sees you almost guilty before proven innocent. So it's up to you to provide all the evidence and prove and declare and formalize anything and everything. Nothing is going to automatically happen for you, unfortunately. And we get a lot of that confusion through People assume I've left or I'm working abroad. I don't have to declare anything to SARS. I don't have anything local. It's fine. Unfortunately, that's not the case. So the options that exist is that differentiates between being a tax resident and a tax non-resident. We are a tax residency-based system in South Africa, which I always say is great. It's better than being a citizenship-based system. It's not as great as it used to be when we were a source-based tax system before 2001. But a citizenship-based system would have been one where, and that's where people get confused, where you would have been, if you're a citizen, that's tied to your taxes. Okay, so people assume, oh, I've given up my South African citizenship, I no longer have to speak to SARS. That's not the case. Okay, so be very careful of that. A tax residency has more to do with our legislation and tax residency tests. They're not to do with your citizenship or anything like that. Now, a tax resident in South Africa, you are legally required to declare your worldwide income, so foreign, local, from third country, anywhere, declare all of that to SARS. And then you apply, be it exemptions or tax credits, rebates, whatever it is. A tax non-resident is only then liable for South African sourced income. Okay, and a lot of people think that just because they've left or they work abroad, they are the second category, the non-resident. Unfortunately, you've got to prove your case. And then there's two different ways, which is exactly what you were mentioning, the annual way to cease tax residency or the once off. And then there's that third option, which is claiming the foreign income exemption, which covers you if you're an employee up to R1,250,000 of your foreign employment income. Of course, each of these routes have the criteria you have to meet, but they're all very good routes to help you and protect you from double taxation.
Okay, well, I think that's a nice and broad answer. Now, let's say I'm in South Africa, I want to immigrate to America, and I go through the whole financial immigration process, and we can go through all the nitty-gritties of CGT and all those exit tax and everything in a moment. But let's say I want to move out, but then in a year or two's time, I decide I don't like USA, I rather come back to South Africa. What would be the strategy moving myself back? Would it merely just be letting SARS know I don't want to financial immigrate anymore? I'm back in the system, or what do you do?
So firstly, on the good news side, absolutely you can come back. We're a tax residency based system again, which means you can reinstate your tax residency, okay, if you've seized it, be it once off financially immigrating or the double taxation annual agreement way. It's all case dependent again. So that's why I say always get the right advice, because the way you seize your tax residency, especially the financial immigration once off way, is dependent on your permanent intent. Okay, so are you intending to reside abroad permanently? And again, it's the word intent, because we can't guarantee life. We don't know what's going to happen. It could be a visa issue, could be a health issue, could be a million different things that would make you, move countries. Now, say you do move, doesn't work out, you come back, there are ways absolutely to reinstate yourself as a tax resident and still protect yourself backwards, okay? Again, it depends on the situation, but most likely it would be unforeseen circumstances that your permanent intent changed and you're no longer going to be staying in the States. You're now going to come back and live in South Africa on a permanent basis again.
Okay. Right, so then I've touched them quickly, but financial immigration, now I know there's this exit tax, potential capital gains tax. How would that work in a situation with financial immigration?
All right, so the exit tax, as we call it, is actually something that's seen as a very greedy part by SARS, but it's actually not when you break it down as to the reasoning why it exists. So the exit tax is a capital gains tax as a deemed disposal. Basically, when you own capital assets, they look at it as if so they'll look at your worldwide assets, by the way, at that point for the exit tax, so not just South African. And capital assets, it's not personal use assets, not vehicles, not clothes, things like that. It will be more properties, trusts, vested trusts, shares, any businesses, things like that, like an actual capital asset. And they look at the value it has at that point from when you acquired it versus then. And they say you're deemed to have disposed that asset, so sold it and reacquired it again on the same day. That way they can tax your capital gains until that point. Now, the reason for this is because when you become tax non-resident, be it the annual DTA way or the financial immigration way, you are no longer due then to pay capital gains tax in South Africa on anything, be it South African or foreign, except for South African property or property-rich companies. Okay, which is then why properties are excluded, South African properties are excluded from this exit tax. So this could be your biggest hurdle when considering ceasing your tax residency. So that's where a bit of tax planning needs to come into play. So always speak to an advisor and plan your timing, plan your assets, see what you hold, how you hold it, what has it grown in value, would it qualify for the exit tax? But yes, it can be quite the hit for some people, or some people don't even have, some people are very liquid. So it's definitely something to get a consultation on.
And just lastly, before I get to one of the case studies. So let's say I did immigrate to USA, but I kind of forgot about my taxes 2-3 years down the line. Is there any way that I can potentially backdate an application to the date that I actually exit South Africa?
Absolutely. And I'll tell you the once-off way, and then I want Tom to kind of dive into the details of the DTA way, because they differ slightly in the way you do it. But absolutely, you can backdate. Okay. Of course, we can never really save you from any penalties maybe we can assist you with, but late interest, stuff like that. But you can backdate and protect foreign income. Because remember, it's especially the financial immigration, it has to do with your intent. So was your permanent intent from the day you left, or was it afterwards? Did you go for a year and then decide, oh, now I actually love it, I do want to stay? So that's the date you kind of look for when you think, when am I going to cease tax residency?
And then on the other side, when you're going for the annual route and ceasing tax residency, it becomes a little bit more finicky from a backdating perspective. Really speaking, when you use a double taxation agreement, the annual route, every year you have to prove that in that year you met the factual requirements to be seen as a non-resident, or at least an exclusive resident in the other country that we have the DTA with, where your permanent home is between the two countries, where your center of vital interests was, where you're habitually residing most of the time between the two, and where you're a national. Those will all decide it. But when it comes to backdating, 3 years is generally your cutoff, unless you haven't filed returns for longer, in which case, as Victoria said, you're still subject to that risk of penalties from a SARS perspective. And then even so, if you did file your returns, it might make it harder. If you filed your returns and SARS asked you for additional documents and information, you can't simply go back and fix that return, because SARS still needs to audit you when you claim a DTA in your returns. They always, or at least almost always, ask for evidence to back up your submission. So as long as you have that evidence, and as long as you can file those returns going back to claim that DTA position and prove it for that period, you can potentially backdate, but it's not as easy a process as it is with financial immigration. And the proof element is, I'd say, 1 or 2 steps more burdensome.
Yeah, I agree with you, definitely. I think also just a point that I think on general tax, the moment you start letting your taxes go and then need to update, it's sometimes do a backlog of five odd years. I mean, the tendency of an audit is just the risk of an audit is just so much bigger. I mean, just see so much, and to start doing running an audit for 5 years, the different years, it's not fun. So I think rather keep it up to date.
Yep.
Right, case study. I just have 2 case studies. One I kind of mixed in together, but one is going to the US and the other one is going to Mauritius. So I'm just going to read it quickly to you. Moving to the USA as an employed individual, having still rental property in South Africa that will remain here, obviously be rented out, and then potentially also have business interest still in South Africa. So if you need to discuss that with the individual, with the client, what would you advise him to do financial, obviously, I assume financial immigration would be the route to go. But what does that person need to look out for?
Well, the first question immediately that my mind goes to is he moving with a permanent intent? You know, that immediately qualifies or disqualifies him for financial immigration. If he is, let's say, then absolutely, even if there's other options that also work that he might qualify for, that's probably the best in terms of if you have that permanent intent, because it's the once off and it's the covers you worldwide. So at least no matter where you move, no matter what changes in our legislation, you're covered. Okay. Now, say he wasn't going abroad with a permanent intent. Then I'd say to him, okay, well, you're an employee, so that still qualifies you under Section 10102 to perhaps claim the foreign income exemption. Then is your gross income, so before taxes, including all bonuses, benefits, all of that, is your gross income above the R1,250,000 threshold per annum? If it is, you can exempt up to that much. If it's below, wonderful, it's fully exempt, okay? If it is above that, then I'd say, okay, then let's consider go to the DTA option. The US absolutely has a DTA with South Africa, and that's where we would fully exempt all foreign income, not just employment. So everything from the States that he earned, employment, personal, whatever. If he had another rental in the States, he could still exempt it fully. So there's no cap on that one. So think of it this way, DTA and financial immigration, no cap on the foreign income you can exempt. Section 10102, the foreign income exemption, the remaining tax resident, there is a cap. Okay, so again, depends on what it qualifies for. But the other important things you mentioned there are that he's going to keep a rental property in South Africa and a business interest, which absolutely, whichever route he goes with, he's allowed to. Okay, you don't cutting ties with South Africa, whichever way you choose, be it once off seizing a tax residency annually or remaining tax resident. It doesn't change your right to keep assets, reinvest. You can even get credit, have debts, finance things. It doesn't matter. The important thing to remember is that whichever way you go, you're still going to have to declare your South African income to SARS. So he's going to have to, that rental income and any business interest, he's going to still have to declare it to SARS. And then, you know, he can claim the normal deductions and all these things.
So obviously the rental property, that once he's financially immigrated, the rental property is an easy solution or easy answer. It's, I receive rental income, I need to declare the South African income tax return.
Correct.
Business interest. So if you have business interest in South Africa, obviously when you receive a director's remuneration in South Africa, you need to declare the South African tax return. But
so with that, it gets a little bit more complex when you bring a company in. So the first thing we must check is he 100% shareholder? Is he 25%, 50% shareholder? Because that might affect the tax status of the company as well. But nonetheless, depends on how he's drawing. Is he drawing dividends? Is he drawing a salary? How is he getting paid through it? Okay, there is a withholding tax on dividends for non-tax residents in South Africa. But I think the main thing to consider in both of these remaining South African assets, the business and the property, is that it's going to be taxed and treated in South Africa as normal. But keep in mind that you need to also consult with someone in your new tax jurisdiction. Because if you're a tax resident, or in the States case, you're already, you know, it's a whole other level with federal and state tax there, but you might also be liable to declare any South African income to them as well. And then depending on, claim any credits of what you've paid in South Africa, etc.
So based on that South African income, so would it be possible for South African company then to rather, for that director, let's say there's more than one shareholder, so it's more than one partner, to rather start a new company in the US, obviously with their tax consultants, and rather do something like a consulting fee between the South African company and the US company. So it makes, obviously, you transfer the tax obligation from South Africa to the US. Will that be possible?
Absolutely, and I'll actually let Tom dive into this a little bit deeper, but again, case dependent. I know I keep saying that, but it's very important to remember.
Yeah, thanks, Victoria. You've actually hit on to what I've often joked is a lawyer's favorite answer. It depends. And it very much does. You know, if we take a cookie cutter example where it's a simple consulting business, perhaps it's just the two of them with no employees, then maybe that is something that you consider. I mean, a partnership, for example, is a fiscally transparent entity, but it creates a lot of confusion from a double filing perspective, let's say the US and in South Africa, when you need to, as a fiscally transparent entity and as a partner, file and declare your taxes. As an employee of a company, or let's say an executive director, it's a similarly difficult thing. Technically, he can live in the States and file his taxes there, declare his director's rem or his employment income. Company can keep filing in South Africa, but there is that risk of creating a taxable presence in both countries on the part of the company, firstly, and secondly, it's just not best practice. You know, if your worldwide obligation becomes the US, for example, then you're going to want to be on a US payroll, even if you're just working in there for a significant amount of time. So your suggestion in that regard, perhaps opening a separate company in the US, having an SLA or service level agreement between the two companies, or having perhaps a group of companies in this context might be a useful answer. But it very, very much depends on what the business is, where the business is, what size the business is, how much it profits, and at least a handful of other variable factors before you can put together a strategy. One thing we would say is it's better to have that strategy in place before you find yourself in the other country. That's for sure.
Yeah. Thank you. Very good answer. Thank you very much. Well, let's move to Mauritius. Let me go through the case study with you, and then we can discuss that as well. So, Brian, moving to Mauritius, not certain at this stage if they want to stay there. So it's obviously, I think most people potentially moving to Mauritius is kind of testing the waters on that side. So let's say the person current intent would be a year or two. He will remain self-employed from his business interest in South Africa, so he won't be employed in Mauritius. What would his exit strategy be and potential business structures that you might advise to them?
Well, just going on the assumption that when you say he's self-employed, he's a sole proprietor. He's not an employee of anyone. Then he wouldn't be able to rely on the 1.25 million rand exemption, because that's something that only applies to employees for foreign work days. Although it doesn't matter if it's a South African employer or a foreign employer, this person doesn't have an employer. They are their own. So we look at their intention. Because their intention isn't to permanently leave South Africa, they very much intend to come back, not just for holidays, but on a permanent basis, as you say, within a year or two. The DTA route, the temporary annual route, is the best for them. So the way that whole inquiry works, without overcomplicating it, which would be almost too easy, is step one. Expat must ask themselves, am I seen as a resident in the other country? Not for immigration purposes, that's separate, but for tax purposes. Does Mauritius see me as a tax resident? Do they want to tax me on worldwide income? And in most countries around the world, you're not South Africa, but in most other countries, you're seen as a tax resident if you're there for more than 183 days, either in the calendar year or their specific tax year, or in any 12-month period. In Mauritius, it's in their tax year, which runs from 1 July to the last day of June. Assuming that you've been there for that time, you're a tax resident, then backdated from day one when you arrived. You're also seen as a tax resident of South Africa, being a former ordinarily resident, intention-based resident here. So that gives you access to what we call the residency tiebreaker test in the double tax agreement between the two countries, because they both see you as a resident. They both want to tax you on worldwide income. Now you apply the test. First, we look at, where do you have a permanent home available? So if this person has a home in South Africa or a property in South Africa, that's fine. Do you have a tenant in there? So preferably somebody who's not related to you. And if that's the case, or you don't have property in South Africa, but you've got somewhere where you can turn a key, open the door, walk in and say, I'm home in Mauritius, whether it's rented or owned, then great, you've passed the test. As long as you can prove that to SARS, that you're a Mauritian resident and you pass that test, you're done. You declare it to SARS and you can be non-resident under the DTA, not pay tax in South Africa on your foreign income. But if you have a permanent home in both countries, place that you can stay, then you look at other factors, where your center of vital interest is located, personal and economic relations. That doesn't decide it, or you can't prove it, then which country between the two over, let's say, 3 or 5 years do you spend more time in? If that doesn't cure it, then where are you a national? And if you're a seriously unlucky chap and you're a national of both countries at this point, then SARS and the Mauritian Revenue Authority will have to hash it out between themselves. But that, in this case, we would declare non-residency to SARS under the DTA. We would get proof of their residency in Mauritius for tax purposes, prove that tiebreaker test. Not always an easy task. SARS has a giant laundry list of verification questions that they ask, but that would be the correct route to follow. Then when they come back to South Africa, they're taxable worldwide again from then onwards.
Makes sense. So let's say this person do have a company in South Africa receiving a director's remuneration on a monthly basis. Would that qualify as part of the 1.25 threshold rebate that you get every year because it's an employment income, or is it too directly related to the business because it's also having obviously holding a directorship and shares in that company?
That's actually a very good question, and the answer, funnily enough, is very simple. What type of director is this? That's the first question, really. If this person is an executive director, then they're an employee of the company for tax purposes. If the person is what we call a non-executive director or an independent director, and they charge fees, they issue invoices to the company for their time, then they're not an employee. So if they're an executive director as an employee, they can claim that foreign employment income exemption. If their income is above 1.25 million, then the 15% Mauritian tax rate won't really help them much from a credit perspective. But if they're a non-executive director, then they're going to want to cease their tax residency.
Okay, that's awesome. Thank you very much. So just lastly on the 1.25. So in any country, obviously you get that 1.25 rebate. And then obviously you get allowed some of the foreign tax credits that you can deduct. Is that also proportional of the foreign tax credits, or can you deduct the whole amount?
Very, 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 very good question. These are just getting better, Jasper.
Thank you.
So the way it works is, you're exactly right. It's apportioned. So the best way to explain is by illustration. Let's say the 1.25 million rand exemption makes up 2/3 of your total gross employment income for the year. Then you'd agree with me that leaves 1/3 taxable in South Africa. So if you're also paying tax in the foreign country, you can claim the proportional credit, but what'll happen is 1/3 of your foreign income is still taxable in SA after the exemption. You can claim 1/3 after that of the foreign tax you paid. It's similar. If 1.25 million is half of your income, then you can claim on top of that half of the foreign tax that you paid. So the ratio will follow that trend.
Makes sense. Definitely makes sense.
And what we see is it's never enough to fully cover, unfortunately.
No.
Exactly. That's obviously the concern as well. So
yeah, that's actually an excellent point, because even especially in European countries, they do generally have higher tax rates, but what you find is a significant portion of that is social security payments that they make, and you can't credit that in South Africa.
It has to be purely income tax.
Tough life in Africa. I don't want to say, it doesn't look like there's any questions. So I just want, just double check before we move on to crypto tax. I see there's a lot of shares, a lot of people watching. So, but let's keep going. I think there's no additional questions. I think there's enough questions and answers already done. So let's just keep going. I'm also respectful on your time. Right, crypto tax. Right, so I think as an opener, as a real icebreaker, you see on a lot of social media, you see all these posts of non-regulated, SARS can't pick me up. So I think in the new, I'm going to ask this question, but kind of, what would you suggest to any person dealing in crypto? Will SARS pick them up? Is the risk on them that they will get audited and that SARS can actually find their transactions?
My answer is please just declare it. SARS is 100% focused on this area. They know how much is invested by South Africans in crypto assets, cryptocurrency, crypto assets, same thing. And they're getting sharper. I mean, we're seeing audits come all over the place. Just this year, I recently saw an over 10 million rand audit, penalties of 125% being levied. They're very much focused on this, and what they see is a lot of these misconceptions from taxpayers. Firstly, it's not taxable until I've withdrawn it, which is wrong. It doesn't involve money. Wrong. A good example is if I'm a Ferrari salesman and you offer to pay me instead of money, but in a house, and I say, yes, pay me in the house instead. I haven't found the ultimate tax loophole. That house still has a monetary value, and SARS can audit from any direction. It's not just that we have automatic exchanges of information from other revenue authorities and financial institutions if you happen to be using an offshore bank account, but it's also that SARS can reach out to those foreign authorities and have them audit you or provide SARS with that information on request, or even collect from you by force if need be, and then pay that over to SARS. We recently saw this audit exercise take place on SARS request from the Irish Revenue Commissioners with Airbnb. South African Airbnb owners renting out the property. SARS reached out to Ireland. Ireland reached out to Airbnb. The information went the one way and then to SARS, and they got notified. It's also lifestyle audits that SARS can use. If you're somebody who's vocal on social media about your trades, that is, funnily enough, very much picked up. We've seen it time and time again. And another avenue, something that made the news last year, is SARS can also reach out to the platforms themselves. It reached out to all of at least the 12 major platforms in South Africa and obtain taxpayer information directly from there. If you're somebody who's had crypto in South Africa, the chances are SARS already knows about you. Not to say that they're going to see every non-compliant taxpayer as an issue. Sometimes it's not worth the collection effort, but 100% loading you on their risk engine. And then there's the last aspect of this, which is a fishing expedition, almost. You could think of it as, if you really wanted to, and this is something that has happened. You don't make any disclosure of crypto in your tax return. Well, SARS may still ask you about your crypto. They've done this, at least I've seen it a handful of times personally, and I've seen it written about many other times, where they ask you, why do you have crypto? And you think to yourself, but I haven't put crypto in my returns. They're asking just in case, they've caught you. Again, it's that analogy. But if you lie, or if you lie by omission, you don't say anything at all, those are criminal offenses. And if you're found wanting, if you're found to have actually not just had crypto, but inadvertently had a liability, you are guilty of a criminal offense. The question is then whether SARS is going to refer you to the NPA. And the point here is not to scare anybody. The point is just to elaborate on what's happening. A lot of people think that SARS can't find them in crypto, but the thing is it's more exposed than ever before.
I think you've touched so many important points there. I try to obviously rewatch again and just kind of recollect it as well. But I've resonated with so many of the points that you made in our practice as well that we see. Something like, I mean, you know, probably as well, but like property also get audited a lot. And they ask you these questions that I know they already know. So this is not a question of, I'm trying to get the information from you. I'm just trying to verify if you're actually talking the truth to me.
Yeah, exactly.
Kind of thing. So it's, I mean, they can push a button and they can pretty much get anything these days. I mean,
that's it.
It's actually so easy. So yeah, I think I agree with you. I mean, it was more a question of getting the answer from you, but it's really, I think it's really important to rather declare and rather get the best advice and declare it properly, and save tax by declaring it properly than not declaring it and creating a criminal case for yourself.
Well, it's actually very amusing. Just off your point, Jasper, you're 100% correct. They already know. Sometimes when they're auditing you, and the difference between a verification and an audit, you know when you're being audited, right? So when they audit you, they tell you, sometimes we already know, but the amusing thing is they ask you if you can use the voluntary disclosure program for amnesty. So if you should have disclosed something and you didn't, you can VDP.
Yeah.
The problem is once SARS has notified you that they're looking at you, that VDP is no longer voluntary, so they're rejected anyway, and now they have all of your information.
Yeah.
It's
crazy. So yeah, I think it's rather be careful, rather declare and make sure that you can rather declare and make sure you declare as and deduct as much as you can than not declare. Right, you mentioned about cash out and not cash out remains taxable. So let's say let's create the 10,000 Rand example. 10,000 Rand, I bought some crypto in there, and it grew to something like 20,000 Rand worth of crypto. I haven't cashed it out yet. Do I need to declare it in that specific year, or only when in the following year when I actually cash it out, will I be taxed at that stage?
Very, very good question for clarification here. So you don't get taxed on cash out, but you also don't get taxed on your assets simply increasing in value. There's a sweet spot here. So let me explain. In your example, it's simply grown in value. There's no tax there. You know, there has to be something that happens for tax to arise for that year. If you were to sell that crypto or a portion of it, if you were to swap any of it for another crypto, including stable coins, or any other assets or goods, services, you know, then that's what will create a tax liability. You're earning crypto through interest, staking, whatever it may be. You know, if you're earning interest on a loan, the crypto loan that you've given, these are all taxable events. But simply having the crypto, that's not a taxable event. You know, it can go up, it can go down in value. It almost certainly will. But you only think of the tax when there's been some kind of transaction that's taken place in the year.
Right. Following on that, so with shares, obviously there's that rule of that 3-year period, capital gains tax, so it's revenue up to potentially 3 years, and then after that, it's most likely to be capital gains tax. But you can also motivate with SARS before that, and we've got it right before 3 years. If you can show SARS, but I bought some shares, I don't really trade. There's no history of me doing a lot of trades. It's really, I bought some Sasol shares in lockdown and it went up, and now it's amazing big amount, and I just sold it because I want to potentially buy a property. Is that the same criteria with crypto, or is there some other criteria that you need to look out for?
It's a highly technical answer that needs. So I'm going to do my best to not put the audience to sleep. So this hits the issue of, is it capital or is it revenue? And an amount is generally one of these two. Now, the difference is here, if it's capital, then the tax on it is maximum 18% for an individual. If it's revenue, then the tax on it is maximum 45% for an individual. So naturally, everybody wants their crypto to be seen as capital. But the thing is, capital is reserved for your more passive, longer term investments. The 3-year rule that you mentioned is only for shares, not for crypto, which a lot of people still get wrong. But, you can't only look at how long you're holding something. I could have trading stock on a shelf for a very long time before it gets sold. Doesn't mean that it's not trading stock. It doesn't mean that I haven't been trying to sell it or I haven't intended to sell it the whole time. So the first thing SARS is going to look at is, are you trading in these cryptos, or are you simply waiting for it to increase in value and maybe sell it or use it for something useful or make other money out of it? Use it to stake it, to earn other crypto from it. It's a very gray area. You need a very sharp advisor to make that determination. An experienced accountant or a knowledgeable tax attorney will be able to assist you there, but it's not something you should take chances with. You can absolutely get it right with SARS as long as you motivate correctly.
Yeah, I must say, it's something that I find with SARS, but I mean, we receive a lot of, obviously, you get a lot of audit on a monthly basis. And when you motivate something properly and with the right intention, SARS generally, they're open to discussion and open to kind of see your opinion as well. Not always, but in a lot of cases. So it's I think there's different opinions. It depends on the audit case you've handled, but it's I think in most cases, I found that the moment with us in any case, when we submit something, we must make sure that before I submit, I can motivate anything that's on that tax return. And I think at least if you have in your heart the correct motivation for that declaration, that's already, I mean, especially with this, and that's in my heart, I feel I stole something, but it feels good to me. But it's like really the intent of this case is I just merely hold one set of shares and one set of cryptocurrency. And I've sold it in 2 years, and I really do believe it's capital. So, but I agree with you. I think obviously expert advice is always the correct answer. Just to elaborate on that. Right. So I think a big question. If you don't want to answer me directly, you just say cut. But so you also see something also say on social media with cryptocurrency. Obviously, when you want to transfer money from South Africa to a foreign country, you need the Reserve Bank approval and all those kind of things. But I think there might be a lot of transactions going through a cryptocurrency exchange to another country that's never gets approved or never been seen by any Reserve Bank or anybody. So what is your view on that and opinion on that?
This is a very contentious area. So, I'm just gonna go ahead and start what I'm saying with, this is not formal advice. And this is my professional view, but it is a contentious area. So you're probably going to see other views out there. Now, crypto is not currently regulated specifically from an exchange control perspective. So, starting from outbound financial flows, sending money out of South Africa or the Common Monetary Area, Southern African Common Monetary Area, for crypto. Let's say I want to send crypto money to Germany to buy crypto on exchange that side. That's fine. as long as I'm within my single discretionary allowance of 1 million rand per calendar year, that's okay. I can use that for whatever I want, as long as it's legal. If I want to send more than 1 million rand out of South Africa for that year, then I need to apply to the Reserve Bank for a foreign investment or foreign capital allowance, or FIA or FCA, which then allows me to send up to 10 million out. Now, if you're an individual, it's relatively uncomplex. As long as you can prove the source of your funds and you're compliant, including tax compliant, then you can send that money out. For a company, it's more complicated. A company will require SARB approval, and I mean, we did a request 3 years ago, and it just wasn't forthcoming, and it hasn't been forthcoming. So SARB is not approving companies to invest in crypto from abroad. But as far as sending crypto out of the country is concerned, that is the most contentious thing. Depending on who you're talking to, and especially depending on the time of day, it seems, including at Reserve Bank, who you speak to, the answer may be different. Either it's illegal or it's simply not regulated. What I can tell you is what I see in practice. And in practice, the exchanges, South African exchanges and foreign exchanges, crypto exchanges, are allowing you to transfer crypto between borders. And absolutely nobody has been prosecuted for doing that right now. So I suppose, the key that most people are using to open the door is keep it reasonable. Don't send too much abroad. Keep in mind, perhaps simulate your SDA, your FIA limitations. Crypto coming into South Africa is also completely unregulated. There are no controls, but it's also not recorded for SARB purposes. So if you're doing something like arbitrage trading, not only can you not be doing that with loan money, but you also can't use the crypto coming back into South Africa to say, well, I brought my 1 million rand back, I can just use that again. You have to apply for that exchange control approval.
Yes. Yeah, thank you very much. I think that's very insightful. But the point I'm really taking from this is you can use your 1 million rand discretionary allowance once a year. If you want to go above that, or when you want to bring in and do that again in the same year, then you need to start looking for the approval. And like you mentioned, you can get a tax clearance with SARS, especially for doing that. So I think that's very insightful. I only have two more questions. And assess loss. So obviously, in a tax scenario where I receive, let's say I receive employment income and I obviously do some trading in crypto, with the crypto market being very volatile the last couple of year or two, you might potentially have assessed losses. Now, I assume crypto would be one of the suspect trades as part of the ring fencing module. What do you suggest someone do if they have assessed loss? Do they deduct it in that first year, potentially from the tax return, potentially get a tax refund? But if it continues that 3 out of 5 years, would you ring fence it, or would SARS ring fence it, and then obviously build up towards the point that you actually receive a taxable income from crypto, and then obviously deduct the loss? What is your views on that?
So I love the term suspect trades. It is often used. I prefer hobby trades or hobby losses. But okay. You're correct. It's listed, which means that, just for the benefit of the audience, ring fencing means that if you have a loss in this trade, you can still offset it against later profits in that trade, but you can't use those losses against profits in other trades, like renting, if you're making losses in crypto. So using the basic example of the 5-year ring fencing rule, if you make a loss for any 3 out of 5 years, so a 5-year window, 3 out of those 5 years you made a loss, then that means that you, as you said, you can only deduct those losses against profits that you make in crypto. What you need to prove is either a very reasonable likelihood that you're going to make a profit soon in the following year, or actually make a profit in that following year and bring yourself out of the 3 out of 5 year window, which can be difficult if it was your 3 most recent years, because then you've got 2 years that you have to make a profit, or try and prove to SARS and get them to agree with you. What will happen is SARS will ring fence that for you. It's contingent on you making those disclosures in your returns, which is always advised to do anyway. Otherwise, facing the possibility of ring fencing is still better, because it allows you to offset for a while, rather than not disclosing losses at all, because then, as far as SARS is concerned, it's all profit all of the way. I hope that covers the question.
I just want to make sure that you agree with me in the sense of that if it's once off, let's say 1 out of 5 years you have a loss, that you can actually use that loss and offset against the employment income or any other income in your personal capacity, and you will potentially get a tax refund.
You can absolutely offset your. I'm not sure about if you've already paid the tax, for example, as a provisional taxpayer, then yes, it would lead to that refund. But you absolutely, in a year 1 loss, for example, you can set that off against rental income. You absolutely can. Yeah.
Right, and just lastly, based on, obviously there's a lot of people that do crypto mining as well. So if I buy, as in regards to a deduction, the equipment, the hardware equipment that I would need to buy, computers, those kind of expenses, would that be subject also like normal tax, where you would deduct it as over, let's say, a 3-year period, or can you deduct that expense in that very first year that you incur the expenses?
Yeah, the technical answer would be to talk about fixed costs and floating costs. But I prefer to talk to clients about what have you incurred an expense for as a resource versus what is an overhead. So going back to capital and revenue, whatever's capital that you've bought, so technically resources, assets of yours that help you make that profit out of mining, that's capital. You can't use those expenses as deductions. Your computer, your rig overall, any resources that you purchase that allow you to mine, that you cannot deduct. Those expenses you can't use. What you can use, however, is data, electricity. You use a certain portion of your home for it, great. The cleaning costs for that. These overheads, these more regular expenses, these are things that you can deduct from your earnings.
I think that's all my answers, all my questions.
Brilliant.
It was a really fun morning with you guys. Thank you for all your amazing, insightful answers. I really appreciate that.
Thanks for having us on, Jasper.
It's been an absolute pleasure.
I think for everybody watching, I see there is some questions, but just before I go to that, for anybody watching, I always arrange a quick free Zoom call with either Victoria or Thomas regarding a specific subject. So if there's anything that you need to declare, need to do, and need to discuss, financial immigration, crypto, please be in contact with me and I will arrange a Zoom call for us. With them, I'll turn it on for a consultation. But thank you, and thank you very much for everything that you do for our practice as well and for our clients. I just want to quickly see if I get to just say the great discussion, very informative. Thank you very much. I've never done any crypto returns before and want to be compliant. What would I need?
Good question.
Tom, go.
Yeah, sure. I mean, you're going to want to have somebody to assist you. You do have certain crypto calculation tools out there, but none of them actually speak to South African law. So you're going to want an accountant who knows crypto, preferably, to have a look at it for you as well. What you'll need, on every crypto platform, they make available their metadata on your transactions, CSV, like Excel spreadsheet documents. You can pull those. It's almost like an account statement for crypto. And some of them use an API key, which allows you online on another platform to pull the transactions through to make those calculations. So have a chat with somebody who knows crypto tax. They'll talk you through it, telling you what you need and what your options are to find your tax number. That shouldn't cost you anything. Yeah.
Great. Thank you very much. Awesome. Thank you very much for your time. I really appreciate it. And I'll definitely speak to you guys again soon with some of the Zoom calls that we'll arrange for you guys.
Thank you.
Thank you, Jasper. Thanks, everyone.
Thank you, everyone. Bye.
Bye-bye.
Hi, Jasper Basson here. I just wanted to remind you about the Daily Entrepreneur Tips series. It's a business growth series for entrepreneurs and contains financial information and also information to grow you as a person and your business, because we will never grow our business any higher than we grow ourselves. So click on the link below and I will send you daily information to grow you as a person and your business, and it's for 365 days of the year.